Holy crap, tomorrow is like the Super Bowl for stock market investors. Every 2 months or so, you have this event, and that is Fed Jerome Powell. A report comes out at 2 p.m. Eastern Standard Time. The conference starts at 2:30. Both of these things put together are very important for markets and can typically cause huge rallies or big drops. In fact, the rally that we're in right now was caused by the Fed. With that in mind, I do want to go over my expectations, because what's actually interesting about this is for the first time in a while, we've started to see inflation ramping up again. And the markets are not expecting much of a change from the Fed. I think that is a flawed mentality, a flawed outlook, whatever terminology you want to put on it. Maybe people are just not the brightest. It is Wall Street after all. I think there's going to be a change from the Fed. Question is, how dramatic is it? What do I expect to actually be changed? That's what can be important for the markets. And the specific scenario that I'm talking about, it doesn't seem like a lot of people are talking about it. And in fact, if you look at what the QQQ, the ETF for the NASDAQ, is pricing in tomorrow for the March 20th expiration, it's pricing in about $4.43, which is about 1%. And most CPI reports price in about 1% for the index move. So you're actually not pricing in a lot for tomorrow, which could mean for a surprise to the upside or to the downside. I'll do my best to explain this to you here in this video as clear, concise as possible, and what the possible implications can be for Tesla stock. So do me a quick favor, hit the like button, subscribe to the channel. It costs you nothing. If you find value out of this video, let me know down below in the comment section as well. Let me know your opinion on what the Fed is going to do. Now, here's the general consensus on Wall Street. The Fed's not going to change the dot plot. The last dot plot we had looked like this. And the Fed was expecting the federal funds rate by the end of 2024 to be about 4.6%. If the Fed funds rate is 5.25 to 5.5%, while one rate cut would put the Fed funds rate down to 5 to 5.25, another rate cut would put the Fed funds rate from 4.75 to 5, and one more rate cut would put the Fed funds rate to 4.5 to 4.75%. If that doesn't make sense, the simplest way to put it, the Fed was forecasting about 3 rate cuts in 2024. The general consensus is that's not going to move much. Now, what's actually interesting is Goldman Sachs, they're really not expecting much of a movement as well on the short duration outlook. But Goldman Sachs is actually expecting the Fed could raise the long-term federal funds rate, the neutral rate. So right here, you'll see longer run. It's this column. It doesn't get moved that often. The last summary of economic projections, the Fed upped the unemployment projection, long run, from 4% to 4.1%. Big deal. Nobody even talked about it. Who cares? Well, the Fed funds rate stayed at 2.5% for the projected longer run rate. Well, Goldman Sachs is coming out today and says this could get raised. Quote, "We think the risks are now higher than they have been, that this repricing higher in longer dated rates continues. This week's Fed meeting could, as it has in the past, serve to refocus investors on the question of whether neutral rate pricing should be higher." And really what Goldman Sachs is referencing is the 10-year Treasury. I've talked about this before here on the channel a couple different times to really explain what's happened to your interest rate sensitive stocks. We went from pricing in 7 rate cuts in 2024 down to pricing in where we are now at about 3 rate cuts. We're aligned with the Fed. Well, the 10-year Treasury in this time frame has been rising. Your 10-year Treasury is deemed your longer term kind of interest rate, right? So on the dot plot, longer term would be like 10 plus years. Well, your 10-year Treasury started off this year at about 3.8%. For whatever reason, it just doesn't want to load. And now it's at about 4.2 0.29%. So you've actually seen the 10-year Treasury yield rise a lot in 2024. And that's why interest rate sensitive names have done poorly, like really bad. In fact, year to date, if you were to exclude the top 2 stocks in the Russell 2000, which are MicroStrategy and Supermicro Computer, which have accounted for 41.5 points of the Russell 2000's year-to-date gain, exclude them, and the Russell's actually down 2.1% year-to-date. So no wonder your portfolio might be not feeling the greatest. As markets continue to rise, the average stock hasn't done much of anything, especially if it has anything remotely to do with interest rates. Now back to what Goldman Sachs just said. If the median Fed dot shows fewer cuts, or if the longer run dot does begin to shift up, we think there is a risk that a more hawkish than expected outcome at this week's FOMC meeting would challenge market views of the potential future funds rate distribution. So what that means, kind of in English, is if the longer term rate is higher, if it goes from 2.5 to 2.7%, if you will. That means potentially more restriction on the economy for longer. You're not going back to that easy money policy, if ever, but for a long time at the bare minimum. And you have to discount future earnings more. What I mean by this is go back to 2020 and 2021. If a 10-year Treasury bond yielded you 1%, then let's say after 10 years, you're going to make 10%. Big deal. You discount your stock that you're looking at, a Fubo or a Tesla or whatever stock you're looking at, and you discount their earnings by 10% because that's the difference of a risk-free return you will get in a 10-year Treasury or a not risk-free yield you could get in a 10-year stock you're owning for 10 years. Whereas like if Tesla said they're going to do $300 billion in revenue in 10 years, you got to discount that. Well, if the longer term rate goes up, you got to discount that even more. That's bad for current valuations. And really that's bad in general for longer term valuations, for shorter term valuations. Higher Fed funds rates for indefinitely or for longer at least, that's not good, especially for interest rate sensitive stocks. Now, there is a lot of various opinions from Wall Street on this event tomorrow, what the Fed's going to do, what the dot plot is going to say. I'm going to give you my expectation right now, and we'll look at other people's thoughts around this. But here's my expectation. I'm looking at this more logically. We've seen inflation start to ramp up. The Fed knows they took a big hit to credibility. People started to really question the Fed because the whole time inflation was going higher or starting to go higher, the Fed was saying it was transitory. The whole transitory almost turned into a meme or something to make a joke of. Well, I think the Fed's somewhat traumatized from that. I think the Fed does not want to make the same mistake as they did last time and just let transitory, or what the markets deem as transitory, the last 2 or 3 months worth of inflation, just let it be. I don't think the Fed wants that to happen. Now, there's a couple different approaches the Fed could take here. The Fed could come out and raise rates unexpectedly, which they don't want to do that. That would be a black swan event. There's not even a chance of the Fed raising rates anymore. That would probably cause a circuit breaker in a single day. The markets would probably fall 7%. Inflation probably wouldn't be an issue anymore, but you could probably head into a recession in the next couple of months. That's not exactly what the Fed wants to do. The Fed doesn't want to shock the markets. But how we're positioned right now with expectations, it's almost as if the Fed has to shock the markets. What I'm expecting is not a big change to the dot plot. Maybe the longer term rate does go up from 2.5 to 2.6, wouldn't surprise me. Unemployment rate, GDP, for those to fluctuate a little bit, doesn't matter. The markets are really going to focus on the 2024 projection for the Fed funds rate. And again, that was forecasted at 4.6%. I don't think we're going to get much of a change here. It might rise to 4.8%. That would imply 2 rate cuts, not the 3, but 2 rate cuts. Because remember, right? If you were to get 2 rate cuts, you go from where we are now, 5.25 to 5.5. You drop to 5 to 5.25, and then you would drop from 5 or 4.75 to 5. So anything higher than 4.7, like 4.8, you would be implying 2 rate cuts from the Fed in 2024. I don't think that's what the markets would freak out about. Now, if the Fed revises this all the way down to where they had previously in September at 5.1, then maybe that would cause a little bit more fear, if you will, because that would only be pricing in 1 rate cut. But I think we've already seen in 2024, we went from pricing in 7 rate cuts to now pricing in 3 rate cuts, and the markets just continued higher. Sure, interest rate sensitive stocks did poorly, but the broader markets, the S&P and the NASDAQ, did not care at all, and you unpriced 1% worth of rate cuts from the Fed in 2024. So I don't think it matters really what the dot plot says, as long as it's not a big shift down or a big shift up. If 1 rate cut gets fluctuated, markets are not going to care about that. Where I'm expecting to get the hawkishness from Powell is the logic in why this market is rallying. And if there's one thing you take away from this video that I'm almost confident will be correct, it's hard to be confident in the Fed because anything can happen, but I'm fairly confident in this. The Fed is going to very clearly communicate to the markets if inflation continues, the inflation we've seen in 2024, the Fed will not hesitate to raise rates again. Now, why that could be such a shocker is the Fed has really backed off of that stance. The Fed is, the last couple of Fed meetings, anytime you heard from the Fed, they're all like, yeah, we're probably not going to have to raise rates. Fed funds rates probably at its high for this cycle. We're seeing progress on inflation. I think the Fed cannot box himself into a corner right now. Because if they continue to go on with the same old, yeah, we're going to start cutting rates, give it 1 to 2 months of hotter than expected CPI reports, then the Fed really has to rug pull the markets and actually raise rates again. I think if you precondition the markets now for the possibility of raising rates again, that's a problem. Now, if you look at what the markets are pricing in, you're not pricing in any chance of a cut in a hike in 2024. Not at all. There's a 1.3% chance of no rate cuts, no hikes, nothing, just a pause in 2024. There is a 0% chance of a hike. And that's why the markets have been rallying. Again, it's not the amount of rate cuts. It's the next move from the Fed is a cut. It's not a hike. We should buy stocks based on that. If the Fed throws it up in the air again, that it could be a cut, it could be a hike, it depends on the data, that's where I think you get the markable downside in the markets. Yes, on January 31st, take a look at what asset prices have done since January 31st. Okay, so if you're looking at the NASDAQ, since January 31st, the NASDAQ is up, or was up about 7.5% at the peak. You're still up roughly about 5% since then. The S&P is going to be a little bit less than that. Look at crypto, like Bitcoin. Even though you've seen a little bit of a sell-off recently, even heading into the Fed, little problematic there. But look at crypto. I mean, since January 31st, holy moly, Bitcoin is up, 52%? Okay, I mean, these things are probably not directly translating into inflation, but it's not helping the Fed here. It's not helping to bring inflation down. So I think the Fed, to a certain degree, probably wants a cool down in asset prices. I don't think the Fed wants to ignite a larger market bubble. With that said, I do believe there's going to be some give and take here because we've only talked about the federal funds rate. And again, what I'm expecting from Powell is to really throw it up in the air and make it data dependent again. If inflation continues to come in hot, the Fed will raise rates again. And I think he's going to hammer down on that there's a chance that they will have to raise rates again. Again, that's not priced into the markets at all. There's a 0% chance of that based on what Fed funds futures are pricing in. That would be like a gray swan event somewhat to the markets. I'm sure some people think the Fed may need to raise rates again, but technically it's not priced in the market. So I don't know how much of an impact that would have on the markets. Maybe you drop 2 to 3% on the NASDAQ. And unfortunately, I mean, that's what possibly could happen. So the bulls watching this video are probably not going to like that. Now, I do have something to offer the bulls as well. Quantitative tightening may be coming to a slowdown. The Fed said at the last meeting back in January that they were going to have long, in-depth conversations about the balance sheet runoff. Currently, the Fed is running off $60 billion a month of treasuries that, come due, expire, mature, whatever word you want to put, and they just let that money roll off their balance sheet instead of reinvesting that back into more treasuries. That has also put downside pressure on TLT. When TLT falls, that is upside pressure on rates. So that's another reason why treasuries have been so high and really are not coming down. They're also running off about $30 billion of mortgage-backed securities. Now, the problem here is the reverse repo market. Now, the reverse repo market was set up back during the Great Financial Crisis really to park excess capital, to park excess money. And it really started to be utilized again back in 2021 when the government was spending money like they were drunk, when they were giving out money like they were drunk, okay? And you hit a high of about $2.5 trillion sitting in overnight reverse repurchase markets, reverse repo markets. Now, you're getting down to $446 billion just since August of 2023, which is really in the grand scope of things like 8 months ago, not that long ago, 7 months ago, something, 9 months ago, you were at like $1.8 trillion, 1.7, 1.8 trillion. You've fallen a lot. The excess money is starting to leave the system. The problem is if the Fed keeps running off the balance sheet this quickly, then inevitably you're going to run this down to zero, and then there's going to be nobody else there to really absorb the excess treasuries that you are running off, the $60 billion of treasuries running off. So it's really that excess that the Fed is trying to limit. So think about it like this. If you have $20 billion, $25, $30 billion, whatever the magical number is, of governments, of pension funds, whoever they are, buying bonds every month, okay, fine, that's great. If the Fed's running off $60 billion additional on top of that, right, then half of that needs to get soaked up by, let's say, the banks for this case, because the banks park their money in reverse repo markets. Well, if the bank's money's running low on their excess capital, then who's going to soak up that money if the banks are gone? That's a problem. That could cause the Fed to stop quantitative tightening because you could have a freak out in the bond market. You don't want that. We seen that back in 2019, 2018. You really don't want that to happen. That's a big, big problem. So the Fed is probably going to lower the amount that they are running off their balance sheet. That should put less downside pressure on TLT, and that could put more, downside pressure on yields. That could be positive, but again, is that going to overweigh or outweigh what the Fed says about possibly raising rates again if inflation continues on this path? I'm not sure. So that's where things get a little tricky and actually trying to forecast what the markets will do. You know what you think the Fed is going to do down below in the comment section. Is it going to be a bullish or bearish event coming tomorrow for the markets? Now let's get into a little bit of what Wall Street is saying about tomorrow's Fed meeting. Well, Morgan Stanley's Ellen Zenter says the Fed will likely end up with a 3-cut median this week. So no change at all. Citigroup economist Andrew Hollenhurst said in a client note, quote, "It only takes 2 individual dots moving higher to raise the 2024 median. 3 dots are enough to push the long run dot 25 basis point basis points higher. He says, but the combination of inconclusive activity data and slowing year-on-year core inflation should be just enough to keep the dots in place, and Fed Chair Jerome Powell still guiding that the committee is on track to gain greater confidence to cut policy rates this year. So again, not expecting anything to change. This individual says, we still expect the Fed to cut interest rates in June, although we don't expect officials to provide a strong steer either for or against following the March meeting, wrote Paul Ashworth, chief North American economist at Capital Economics. Michael Gappin wrote, he's a Bank of America economist as well. He says, while inflation has hit a bump in the road, the activity data suggests the economy is not overheating. We think the Fed will still forecast 3 cuts this year, but it is a very close call. Mark Zandi, chief economist at Moody's Analytics, says, quote, they'll make it clear that they are obviously not ready to cut rates. They need a few more data points to feel confident that inflation is heading back to target. Quote, I expect them to reaffirm 3 rate cuts this year, so that would suggest the first rate cut would be in June. So it looks very obvious. Nobody's really expecting much of a change. And then when you're thinking about the Fed slowing down quantitative tightening, that's really a wild card. Nobody has any idea what that's going to look like. But the general consensus is we're going to get the same old. And I roughly, again, align with that. But I think the Fed's going to take a more hardline stance. If the data continues to run hot on inflation, they will raise rates, because what did Fed Jerome Powell just freaking say? He just said this at the last meeting. He said, quote, I'll paraphrase here, that the long-term neutral rate may have went higher post-COVID than it was before. So what does that mean? Well, maybe you got to get rates higher than they previously thought just to be at neutral in the economy, just to put no downside or upside pressure on the economy. That makes a little bit of sense considering inflation starting to rise again as the Fed funds rate is at 5.5%. Now, based on a lot of different sentiment readings, you do have financial conditions at some of the loosest levels they have been at in a long time. That's credit spreads, that's including crypto, the VIX, the markets, cost of capital, availability of capital, credit cards, all kinds of different things that shows the Fed is not even close to too restrictive right now. The Fed could raise rates a few more times without breaking something, I think is clear. Not saying they're going to do that, but they have the room to do that if they want to. And I don't think anyone's really arguing that with the economy, quote unquote, running red hot, or at least at trend levels. Now, this is probably not too surprising to a lot of people. It wasn't surprising to me, but it's kind of like, wow, right? Because there's such a disparity between, if you look at Tesla, the worst performer of the S&P year to date, you look at small cap stocks, excluding, MicroStrategy and SMCI, and you're actually down year to date. Check this out. Wall Street optimism on stocks is at its highest level since early 2022, according to a Bank of America survey. Sentiment among the 226 market pros who responded to the monthly gauge of finance's top investors showed optimism at its highest level since January of 2022, precisely when the markets hit an all-time high. The bank's measure of bullishness takes into account cash levels, allocations to stocks, and the outlook on the economy. It showed a reading of 4.6 on the month, up 0.3 points from February, and well off its nadir high a year ago when the implosion of several regional banks rocked Wall Street. Such surges in optimism can be contrarian indicators, meaning they often are good times to sell. However, Bank of America said average cash balances remain at 4.2%, above the 4% threshold that would trigger a sell signal. The bank's bull and bear indicator is at 6.5, which is bullish but not yet extreme bullish, said Michael Michael Hartnett, Bank of America's chief investment strategist. Several other measures also registered their highest levels since early 2022. Bank of America's general risk appetite measure is at its peak since November of 2021. As part of that, the preference for low dividend stocks is at its highest since December of 2021. Respondents also see small caps topping large cap stocks. Value to outperform growth though the preference is still for high quality over low quality. Very interesting. The level of respondents expecting a global recession in the next year hit its lowest level since February of 2022. A total of 85% expect either a soft landing or no landing for the economy, while just 11% see a hard landing, down from 30% as recently as October of 2023. Which, you want to take that as a grain of salt, but you are at very bullish, very optimistic levels for just overall investor sentiment. And according to Goldman Sachs, stock concentration is now at Great Depression levels. According to Goldman Sachs, the market cap of the largest stock is now 750 times the market cap of a 75th percentile stock, which here you can see you're even way higher than you were in 2000. And when you got to this point previously, like 2021 or so, you were basically peaking out in the markets. It has also been 250 days since the stock market was down 2% or more in a single day. You have to go back to 2017 to get a stretch of time where you have not seen a 2% pullback that has been this long. I mean, like nothing in recent time even comes remotely close to this. And then if you exclude 2017, you have to go back to well before even 2013 to see this long of a stretch without a 2% pullback in a single day. Let's be honest, we're due for a large pullback correction event in the markets. Don't be surprised if Powell is a main catalyst or the catalyst to cause that. Now, I do think there's some solace in this, maybe some good news if you are a Tesla stock investor or an interest rate sensitive investor if you invest in small cap stocks. I know PayPal's a big stock people invest in as well, alongside Tesla, another deemed interest rate sensitive name that really hasn't done much of anything, just continue to fall for many years. Well, I think you're better priced for a hawkish Fed. Okay, so I would still expect the Russell to get just destroyed if I'm correct tomorrow, but I don't think you're gonna see a prolonged sell-off. I do believe you're at the point where a lot of stocks on a peer value proposition look attractive. Then again, you want to look for quality. PayPal, Tesla, quality names that are growing, that are hopefully profitable or near profitability. I think you get limited downside on stocks like that over the next couple of weeks. Where you could get more of the downside is where the expectations are just really high on names like semiconductors, AI stocks, big tech. They're not priced for a hawkish Fed. They're not priced for bad news. When you're in the markets in the short term, the very short term, like over a year period, let's call it 12-month period, maybe a little bit longer than that. It's about expectations. If everyone's expecting a soft landing or no landing, no recession, boom, next thing you know, you're in a recession. Odds are the markets were really good and they got to recorrect a lot. And that's where you get a 30-40% pullback. Not saying that's going to happen, but it's all about expectations. If your expectations are super low like they were in 2022, stocks were trading at bargain bin prices. Meta was under $100. Who the heck wouldn't buy Meta at $100 now? It's $500 per share or so. The expectations were so low, you were priced for a recession. You were priced for bad news. Now you are not priced for a recession, but you're not priced for bad news as well. Whereas the Russell is still 20% off of all-time highs. You're better priced for bad news. So if bad news comes, you may fall less in the areas that are priced for bad news. So yes, I would still expect downside from Tesla, but I do think that would be limited. I could see 150 happening pretty quickly, but I think you're going to find a lot of support around 150. Could you fall lower than that? Of course. Then you start to get a little bit stretched as far as a percentage drop. And I think Tesla could align with the markets. Let's say the Nasdaq's down 2 to 3%. tomorrow or on Thursday, maybe, who knows, then I think Tesla would likely fall something similar. 3-4% maybe. That's what I would expect. But not this huge collapse. I think even Apple, Microsoft, Google, Nvidia, they could probably fall more than Tesla if the Fed is hawkish. Now, again, down to 150, that would be a 14% drop from here for Tesla. Down to 130 would be a 24% drop. And if you're looking at like 120, that would be 29, almost 30, well, little, right at about 30% drop, actually. Is that likely? I don't think so. Is it possible? Of course. I wouldn't hold my breath for that. Now, again, we do have the slowing down, not ending, but slowing down of quantitative tightening that likely will be announced tomorrow as well. And that maybe could offset some of the hawkishness from Powell. And I think that really is the wild card for tomorrow, because how do markets take that? When the Fed injected liquidity into the markets after the banking crisis, stocks took off for 3 solid months until July. And then you came down, you had a 10.5% correction, and it's basically been off to the races ever since. How do the markets feel about a little bit less of a, upside pressure on 10-year treasuries? I don't know. Honestly, it's probably not enough to offset a hawkish Powell throwing a rate hike back on the table if the data continues to come in hot. But it's a possibility. Back to what I was saying, for March 21st, this is not tomorrow, but the day after, the markets are currently pricing in on the triple Qs about a $6 move either direction. So $6 higher from here would be what? 434.81. So 44.81 would be roughly about a 1.5% move. Tomorrow's expected move is roughly around 1%. So you're not really priced for a huge move. The S&P's priced for about a 0.7% move. So you're not priced for a big move. That's where you could get a little bit of expectations getting upset if we do get new information that does warrant a large move. So be on the lookout for that. It looks like options, maybe to hedge out your portfolio. If the report comes out at 2 p.m. or Powell is hawkish at 2:30 and you can confirm that it's bearish, would be likely a good time to take on a hedge on your portfolio. I'm not a financial advisor. I'm not a financial planner. That's not personalized financial advice. That's basically what I'll be looking to do. Now, if you guys want to stay up to date with what Powell is saying tomorrow, if I choose to hedge out my portfolio, check out that link down below in the description of this video. I will be providing live updates. And I always send out my trades every time I make them. Great place to be overall. Check that out. Again, link down below in the description of this video. Go ahead and follow the X account as well if you guys have not done so already. It's Michael Tyler over there. But last but not least, I'll leave you guys with this. If the markets are bullish, if everyone is correct and Powell doesn't change a thing, he stays on the same path that they're going to start reducing rates soon once they gain more confidence that inflation is continuing to fall. If the Fed does announce they're slowing down their bond runoff, maybe down to $30 billion a month, maybe $15 billion a month for mortgage-backed securities, if the best possible scenario is realized, then I think Tesla stock soars coming tomorrow. And I think Tesla stock could even hit, let's call it the low 180s, mid 180s, even by tomorrow. Wouldn't surprise me to have a 4 to 5% rally after Powell. And obviously the rest of the week would probably be pretty bullish as well. So that's kind of the way that I'm looking at this scenario, situation, whatever you want to call it. Let me know what you think, though. I'm curious what you guys think, because Wall Street, I don't even care about Wall Street's opinions. They're wrong all the time. Retail tends to be a little bit more correct, at least most of the time I've found. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.